Welcome to the Stockout. This is your show at FreightWaves for all things related to the consumer packaged goods industry, the CPG industry. I'm your host, Mike Baudendistel. I'm the head of intermodal solutions here at FreightWaves. Also do some work on the CPG industry and things that some of those big shippers care about. CPG companies, as you may know, are a very important constituent for the freight transportation industry. They make up about 1/5 of all freight transportation. So if those types of topics are interested if you're interested in those topics, do a newsletter that comes out every Wednesday at 2:00 Eastern. Would invite you to go to www.freightwaves.com/the Stockout and sign up for that. Sort of put my pencil down at about 2:00 Eastern time and send out what I have. Try to weave in anything interesting related to CPG supply chain. So a lot that has to do with the CPG suppliers as well as the freight transportation markets, leveraging the data that we have in FreightWaves Sonar. Another thing to bring to your attention before sort of going through this week's CPG news would invite you to register for our next virtual conference, which is Global Supply Chain Week. That takes place February 20th through 24th. And there is one day specifically dedicated to the CPG industry and food and beverage. That's going to be the third day, or Wednesday, February 22nd. Some of the speakers we have lined up would include Tom Madrecki. He does the supply chain intelligence at the Consumer Brands Association, which represents a lot of the big CPG companies. And our friend Ben from Black Rifle, who I just talked to last week, he's going to be on talking about the challenges of a very fast-growing supply chain that does a lot in direct-to-consumer, as well as rolling out new packaged goods products. So I encourage you to sign up for that, even though I know it's right on top of the consumer conference in New York, the CAGNY conference, but would encourage you to do both of those things. So with that, I'll move on to the first topic today, which is that grocers and CPG companies are at odds over retail prices. Sort of what else is new, but I think some of those differences have intensified here lately. This was the topic of my most recent FreightWaves newsletter, the Stockout, which came out last Wednesday, and really sort of stemmed from a couple of articles that came out. One from Wall Street Journal talked about that Whole Foods did a virtual conference with its suppliers and reported that they are asking for those suppliers to cut prices. Sort of interestingly, that Whole Foods supplier base is, let's say, skewed towards the smaller suppliers rather than the big national CPG companies that a lot of the Krogers, Walmarts of the world are weighted towards. And I think a lot of those big traditional grocers have lost market share recently. So would expect that to be a big topic of discussion with analysts, questions. Just saw an analyst question the other day from when Mondelez reported. Mondelez, the company that owns Oreo, Cliff Bar, among many other sort of snacking brands, and they weren't on board with the price increase, with price decreases to retailers, because they say that their prices are still going to be higher by double digits in 2023 over 2022 levels. Maybe they're a little bit of a unique case because they're not as driven by a lot of the agriculture, crops. You've seen things like wheat, really come down in terms of the futures price. A company like Mondelez would be using more things like palm oil, sort of things of that nature, not necessarily the crops there that maybe more of Whole Foods suppliers would actually see their price increases decline. And then you've also heard that from other companies too, other CPG companies, which are really not on board with what the retailers are starting to expect, with pushing back harder on prices. Conagra came out and said that they are the most significant price increases are probably over, but still maybe seeing price increases at a slower rate. Unilever said something differently. They said maybe we're past peak inflation, but not past peak prices. So to me, that means kind of second derivative, prices are rising at a slower pace, which is sort of good news, I guess, maybe not great news. And then it was an interesting quote also from Nestle, said that they still have some catching up to do in terms of prices, which sort of gets into kind of the context of the relationship between CPG prices and their cost inputs over the past year or so. I have a sonar chart on this showing the CPI versus the PPI over the past few years, and really what you see there is the consumer prices in white and the producer prices in blue. And you see, if you go back, let's say since the beginning of 2020 and certainly in 2020 into 2021, those prices that the producers paid increased faster than consumer prices. And certainly that was true of consumer packaged goods companies. And you see that trend continuing into about the middle part of last year. So you really had this period of, let's call it 2.5 years, where the margins were really squeezed from a lot of these manufacturers, including a lot of food and beverage manufacturers. Their costs increased faster than they could pass those costs on through the retail channel. That trend started to reverse last year, starting about the middle part of last year. Some of the commodity prices came down. The retail prices are still high. And sort of throughout that period of prices increasing, the CPG companies have had to go to the retailers multiple times, ask for pretty significant price increases, both in terms of more frequently than they would usually ask, and also for steeper than they would usually ask. Was just listening to the Clorox analyst call, and they said that they've gone through now 4 rounds of price increases. They describe them as being sort of cost-based price increases. Sort of clear that it's not because they just want to have a higher margin. But I think what's happened here lately is retailers looking at those commodity prices coming down and doing basically kind of audits of the costs that the CPG companies should be incurring, basically requiring that the CPG companies demonstrate that their costs are really rising as much as they have. I mean, the ingredients are something like half of the cost of goods sold for a CPG company, but there's a lot of other things that go into that: labor, packaging, freight transportation costs. Some of those things are still rising. Even some of the CPG companies are still called out in their fourth quarter that their transportation costs, all in, when you include fuel, higher than they were in the year ago. So all those things are happening, particularly from the traditional grocers. And the traditional grocers are getting more and more concerned that they're losing share to the discounters. I think it's clear that the companies that have gained share in grocery would include the big box companies, the discounters, not Whole Foods, Walmart, Sam's Club, Costco, and including a lot of these private label heavy companies like Aldi's and Trader Joe's. Now they do have all these varying business models, but I think the commonality is they have some value-based approach, either through private label or purchasing in bulk. And maybe a sign of the times, Aldi was the fastest growing retail grocery chain in the last month in the last year. So they opened 29 new stores in January, and in 2022 opened up more new stores than any other outlet, with about 49 new locations, although that was down from what they expected, which would have been 150. And then the second was Grocery Outlet, another one that you would think of as being kind of a discounter, 28 new units. And another point on that topic is that the dollar stores are moving more heavily into grocery too. So your Dollar Generals, Family Dollar, they're expanding the refrigerated capacity that they have for more grocery. So it's really, I think, a situation where the retailers trying to limit price increases from the CPG companies so they don't lose customers and see those customer habits change. So a lot to watch there. With that, I'll move on to topic number 2, move on to a couple of companies that reported in the last few days. Tyson reported today. Tyson shares are down following earnings, and this was a company, I have a stock chart that shows quite a lot of volatility there the last few years. Kind of a yo-yo, but this was one that really was strong during the pandemic. You see all the way down from March of 20, sort of reached a nadir there, but went from about $50 to about $100 from March 2020 to March of 2022 in the 2-year time period. And since has retreated now to $60.81 cents. And when it was at its peak, the government was saying, well, these meat companies are colluding, keeping the prices too high. And I think now you're seeing more kind of the market forces, which really came through in Tyson's results. They had a 68% decline in operating income year over year on a 3% increase in sales, both lower revenue and higher cost of goods sold in the beef and pork segments. Those tend to be the higher margin segments. So it was a larger than expected U.S. beef and pork supplies were reduced demand for chicken. So essentially, the company had expected there to be a shift from beef to chicken, with the sort of consumers going to the lower cost protein, and really there was a larger than expected supply of beef and pork because of the drought in the western U.S. So there was just more of those. The ranchers brought more of the animals to market. So a lot that sort of went wrong for Tyson in the quarter, sort of following some of those periods where they really sort of outperformed. They also said they had to cut chicken prices when demand was short, so they were a little bit wrong on those market conditions. Also, I guess there were also some export restrictions due to the worst ever outbreak of the bird flu. I'm sure everyone's familiar with what's happened with the egg prices, but that's also reduced the exports of chicken because of those concerns, and that impacts the price of chicken here domestically. Hopefully, consumers see lower prices there as a result of that. Tyson also said some interesting things related to its supply chain. So they're streamlining certain ingredient suppliers across dry blends and seasoning. They're also leveraging data to improve inventory visibility and mitigate distress in its prepared food segments, which I guess is the area that there's been more issues in terms of supply chain, and then for doing further things in its distribution network to increase direct shipments to customers, sort of basically bypassing distribution centers, and also just doing a tremendous amount with automation. We've heard a lot about that from them. During the pandemic, ever since they started to have issues having enough workers, so they're doing things like installing automation for prepared food sandwiches, and then their snacking operations. So I think that's part of a longer term trend in meat packing and in CPG industry is more automation. So I'll move on from there to a company that's results were better than expectations. Clorox had a nice share bounce on Friday. I believe it was the best performing shares in the S&P on Friday, up about 9%. So Clorox supply chain is normalizing, which was, I think, the main takeaway from there. I have a stock chart there basically showing that it was kind of the pandemic round trip. Stock went from $140 a share to $240, and then back to $140, and now we're here at $151 after the increase last week. But essentially, companies increased prices quite a few times. They said there's a fourth round of price increases, and their gross margins were up nicely, which is, I think, what surprised the market to the upside. Their gross margins were 320 basis points higher. Pricing combined with the impact of cost savings, and they're expecting their gross margins to be up about 200 basis points for the full year. Now, that's a reversal of the trend that they had been seeing the previous year. If I would have done this presentation this time last year, would have been talking about how great Tyson's results were and how disappointing Clorox's results were. Are seeing some lapping of the last year's results, and I think some of that is just kind of an easy comp for Clorox, but they also are seeing some normalization in the supply chain, which I think is a pretty big deal. The company was able to raise their EPS guidance by 3.5% at the midpoint of the range. They said they've increased the safety stocks in recent quarters, so having a little bit higher inventory. But they say as that inventory, as the supply chain normalizes, they can draw down that inventory, reduce the safety stocks. They said the fourth quarter was the fourth straight quarter they were able to reduce overall inventory levels. They said year over year, they were able to pull about 4 days of sales out of the inventory levels, but are still dealing with some intermittent supply chain disruptions. And the segments they called out would be Glad, the garbage bags. I guess there's some component with the resins that they use in there, and then Burt's Bees. So there's still some intermittent supply chain disruptions in those segments, but on balance, their supply chain is improving. I'll move on to the fourth topic here, which is USDA to regulate sugar and other ingredients in school meals. So I think this was interesting and could impact any CPGs that sell into those markets. I guess what I didn't realize before seeing this article on Food Business News is that the USDA regulates school lunches, and it's not something that's done on a state level. I guess I would have thought that it was done on a state level, but they're adding restrictions starting in the 2025-2026 school year, adding limits for sugar to be less than 10% of calories for the meals for a particular week. And then there's some potential changes to regulations on flavored versus unflavored milk. So this is still under consideration, but they may not allow flavored milk until either the 5th grade or 8th grade. So that could change, things for, the milk producers. And then there's various things on both whole grain and sodium. They're saying that 80% of weekly grains need to be whole grain rich, and the remaining items need to be enriched. Sodium reduction, they're saying a 10% reduction in sodium by the 2025-2026 school year, and then another step down, 10% reduction in sodium in the 2027-2028 school year. And sort of not surprisingly, the American Heart Association likes it, to have these greater restrictions on unhealthy eating. Milk lobby doesn't like it, so they should have more choice there. Some other various food organizations, food lobbies don't like it. They make the argument that the healthiest foods that children ever eat are the ones they have at the school lunches, and they eat less healthy at home, and these regulations are therefore unnecessary. But it does seem like, I've talked about this on previous episodes of the Stockout, previous newsletters, that the USDA does seem to be taking a heavier-handed approach in terms of things like deciding, what's healthy, nutrition labels, all of these things. So it's just part of a really big push right now, I think, to get Americans to eat healthier. I'll move on to the next topic. I always like to talk about the freight markets in addition to what's happening in CPG and try to relate those two things. So topic number 5 here. Freight markets remain loose, and I think you could probably go through 100 charts in FreightWaves that illustrate that. But I think that one of the highlights is just the van outbound tender rejection index compared to the refrigerated outbound tender rejection index. So the van tender rejection index in white line there, the refrigerated tender rejection index in green, and you just see how volatile that is. It's a 5-year chart going back to 2018, and starting in the middle of the pandemic, you saw that the reefer tender rejection rate as high as 50%, the van tender rejection rate as high as almost 30%. We are now at a van tender rejection rate of 3.5% and a refrigerated tender rejection rate of just over 5%. So the shippers think about this as tender acceptance rates, and well over 90% of your tenders should be accepted right now if you're a shipper, and if your carriers are not accepting, something in that 90% range, mid to high 90% range, you need to hold them accountable, find other shippers, change your routing guide, do something, because you should be getting good service, maybe with the exception of if you're running lanes that are really going into undesirable markets. That might be somewhat different, but really should not have a lot of loads falling through to the spot market, which was an issue that a lot of CPG companies had during the pandemic when those tender rejection rates, were much higher. And Sonar would encourage any CPG companies to go in there and look at these rejection rates and volume on a lane-by-lane basis to see, how their tender acceptance rates stack up with the markets in their specific lanes. Also, some interesting charts on van contract rates and intermodal contract rates. I'll shift over to the van contract rates first. So this is a seasonality chart, and so 2023 is the white line, and you see how that's declined. The van contract rates are down about 8%. year to date versus last year. And keep in mind, I mean, a lot of those contracts have not been repriced, rebid. A lot of those will be upcoming in the first part of the year. So you've had a situation where dry van contract rates in green started to decline middle part of last year, were declined sort of throughout last year. Now carriers are seeing lower contract rates. So not only are, the acceptance rates, very high, rejection rates low, contract rates are falling. When we compare those contract rates to spot rates, still shows that contract rates have further to fall. I want to shift over to intermodal for a second. This is intermodal contract rates. And up until a few days ago, this was kind of a boring chart because the intermodal contract rates in white for 2023 were kind of right on top of 2022. That's no longer the case. Those have sort of broken downward, and this was not unexpected. Usually intermodal contract rates follow what happened in the prior year's peak season. If there was a significant peak season, intermodal contract rates tend to rise. The following year, if there was lack of a peak season, they tend to fall. Last year, there really was not a meaningful peak season at all, and we're seeing those rates start to fall. So if you're a shipper, CPG industry or otherwise, it shows that you need to be more aggressive on your contract rates. Looking at those things. Maybe I'll talk a little bit about where that data comes from. That intermodal contract data, it comes from a company that's processing transactions, and so we see that on a day-to-day basis. We also have various data that we're collecting from a lot of shippers themselves. We use that primarily for to look at spot rates where from shippers and brokers. So there's the spot rates that we have in Sonar that we use under what we call the market dashboard tool. We're getting those from a consortium of brokers and 3PLs that provide us with rates that they're seeing in the marketplace on a day-to-day basis. We aggregate them and show you what the spot rate is on a day-to-day basis. You can go in and compare those to the contract rates on those specific lanes. And so if you're a CPG company that you're wondering whether the prices that you're paying in the marketplace are in line with the market, or you need to be more aggressive, or sort of which lanes you're being treated fairly, which lanes you have a higher price on, the Sonar data, you can go in and see exactly how your lanes stack up. There's also some CPG companies that we work with here at FreightWaves that'll provide us with all their sort of rates for a particular month on the dry van side of things. On the intermodal side of things, we actually go in and look at the rates that they're paying versus the rates that we're seeing in the marketplace and show them, okay, well, overall, you're maybe a little bit above the market, but all that variance is driven by these few lanes, and it helps CPGs go in and and negotiate better rates during upcoming RFPs and during their bid process. So we encourage you to leverage all that data. If there's anything that I can help out with there, feel free to reach out to me at mbaudendistel@freightwaves.com. So that's really what I wanted to go over today. We can talk a little bit about what I have working on in upcoming editions of the Stockout. Sort of just booked a time to talk with a company that's involved in the sugar industry called Dumatuk. They are an Israeli company that is involved in providing a healthier sugar alternative. They have a product called Incredo Sugar, which high-tech way to deliver a smaller amount of sugar and have it taste like the full amount of sugar. So there really should not be any compromise on taste. So I'm planning to have them on the Stockout in the coming week. Also have a company coming on called Hemper, which does various paraphernalia related to the cannabis industry, various things related to smoking. That's also a very fast-growing market in the CPG industry. Going to have their CEO on in the coming weeks. And for anyone interested in learning about the challenges that some of the fast-growing CPG companies face, including fast-growing direct-to-consumer CPG companies, you can go back and look at last week. week's the Stockout episode had Ben Ritchie on from the Black Rifle Coffee Company, which is kind of the sort of alternative to Starbucks in a lot of ways. There's a lot they do. The company does a lot to support veterans. They have a product that they're really excited about. That's packaged drink. Can't remember the name of it. It was vanilla explosion or something like that. A lot of their products are kind of named after various military things, and that company expanding very quickly, and they've talked about how sort of their bid process has changed now that they're much larger, need to source greater amounts of capacity, how they've used data in order to get that done. So I would encourage you to go back and look at those things. And, we'll talk next week on probably follow more earnings and talk about the companies that are going to present either at our Global Supply Chain Week or are going to talk at the consumer group, to the consumer group and in New York in the coming weeks. So with that, hope everyone has a great Monday.